Streaming now, this is the Wood TV Live Desk.
Good morning, ladies and gentlemen. I'm News 8 digital anchor Luke Lasser here from the Wood TV Live Desk. Tax season, it's underway. January 24th kicked us off. The national deadline there is April 17th, so you do have some time, but you want to get ahead of the curve a little bit there. Joining me this morning is David Eckelberger. He is the managing partner of EHTC here in Grand Rapids. David, thanks for taking some time to chat with us. We have a lot of points to go over here this morning when it comes to filing your taxes. How are you today?
Excellent.
Let's dive right in here. Let's go start with our important dates here right off the bat. The deadline again, April 17th. We just kicked off Monday. Any other dates in between there that we should know about?
Dates this tax year, very significant. One of the things that just happened, April 18th will be our tax deadline this year. There's an emancipation date that was kicked forward, and the state of Michigan actually aligned with that date just recently.
So it's the 18th. Gotcha.
Significant date. And secondly, we need to make sure along that timeline is the end of the month is when a lot of our W-2s, 1099s should be getting to us. And the important thing there is to make sure that we're starting the tax preparation soon. That's the most important date. There's a lot of technicalities that we're going to be dealing with this year, a lot of new things that we're going to be talking about. And if we wait till the last minute, we're going to be making mistakes. We're not going to have accurate information. And so the most important thing is to get started early and start collecting your information.
So we have a list here of a lot of things to go over. Let's start with what's new this year. We'll start with that earned income tax credit and kind of just roll from there. So what do we have?
Sure. There are a number of new things this year under the American Rescue Plan Act of 2021. A number of things changed, and the specific attention was for those families that had kids. And with children, they really wanted to make sure that they're providing some tax benefits. And the first one that we're going to talk about was the earned income tax credit. One of the big changes for this year is that becomes a refundable credit. And what does it mean to be refundable? That means if you've got a tax liability and the credit is non-refundable, that tax liability can be wiped out, but then there's no additional tax benefit to you. But if it's a refundable credit, that means once your tax liability is wiped out, the government will actually send you money back in addition to that tax liability. So they made that earned income tax credit refundable. The other thing they did was change the age requirements. In the past, you had to be 25 years old in order to obtain that credit, and they've dropped that to 19 years old unless you're a student, maybe a college student, that's still 24 years old. But the other side of that is, in the past, if you were of retirement age of 65, you did not get that credit. Now they've eliminated that credit. So if you're over 64, actually, you can still get that credit. So that was another big change. I think that I call this provision the childless provision as part of that earned income tax credit, meaning that if you do not have children, they effectively tripled the amount of that credit from $500 a year in 2020 to $1,500 in 2022. So that was pretty significant as well. So that's going to impact a number of people. And one of the other unique things with that credit and change that they made is because a number of people were not able to work as much in 2021, they are allowing on your 21 tax return to look at that credit using your 2019 income or your 2021 income. So calculate it both ways, and you're allowed to take the credit under the most favorable result. So another great news for taxpayers, and one of those that could easily be missed. Make sure you're plugging in your 2019 as well as your 2021 income. And if you were one of those individuals that had unemployment benefits as well, that income is not included in this credit. And the way the credit works, it has a cap to maximize your credit, but then at some point in time, the government perceives that you make too much money and the credit goes away. So it's really important to know and understand what type of income is included in that credit. So that's the first credit I'd like to talk about. The next one I'd like to talk about is the child tax credit. This is the one we've heard quite a bit of information throughout this year. think it was in July, they started making payments, getting money into taxpayers' hands, especially those with children. And they had two ways to determine the amount of payment they were going to send to families. The first method was to look at your 2019, if you had filed your 2019 but not your 2020 tax return, and they're going to send you essentially half of what your deemed credit was going to be. And the way this credit works is $3,000 per child under or age 6 and over, or $3,600 per child if they're under the age of 6. So when they did these calculations, they looked at it and at your 2019 or 2020 tax return and started sending out maybe $300 per child if they're under that age of 6, or $250 per child if they're over that age of 6. So you've got all of this income, advance payments on this year-end credit. The year-end credit is essentially, like I said, $3,000 per child or $3,600 per child. That's up from $2,000 per child in the previous year. So pretty significant increase. The other thing they did was they made that credit refundable. Again, these are some pretty significant dollars for a family, and maybe it was a tough year in 2021 because of the work situations. So we wipe out the tax liability, and anything in excess of that is now a credit for the taxpayer, very significant. And again, they made advance payments throughout the year. And one of the things that I think is going to be a little bit of a mess this year for a number of taxpayers is the fact that they had all of these advance payments. And what happened was if you had not filed your 2020 tax return, those advance payments were based on 2019. And then maybe you filed your 2020 tax return and they had what they referred to as plus up payments. Those plus up payments adjusted your monthly payment. And maybe you have another child, so you started getting an additional $300 per month in month 3 of those payments. The other thing that is a little bit complicated in this whole process is each parent had to make this election. So sometimes you had a situation where one parent made the election, but the other parent didn't make the election. So one parent's getting checks, the other parent's not getting checks. We even saw taxpayers make the election to not receive the payments. 2 months later, they started getting payments. So, what they received, the amount they received is going to be somewhat complicated, and that all needs to be reconciled on your tax return. And at the end of the day, if you do not get that number right on your tax return, you could see a 9-month delay in your refund. It's going to be miserable for taxpayers. They're going to get notices. They're going to have to send in confirmation of information. But there's 2 ways to get the right number on your tax return. Again, as I mentioned, in a married filing joint 2-parent situation, each parent will have received a letter sometime in late January from the IRS explaining the amount that they did receive. Secondly, if you didn't get that letter or you threw that letter away, there's a way to go back on the website for the child tax credit, and you can look up the amount that was paid. I really advise looking up, getting the number from the IRS versus just looking at 1 month and multiplying that by 6. That's going to create delays and a lot of headaches for you. So again, as we talked about early, getting started early is the important part, and start getting this information pulled together, because if you don't, it's going to be a headache. And I think a number of taxpayers are going to see some hassles there, but I think we're going to get it pulled together at the end of the day.
So a lot of attention to detail here.
Attention to detail, yes.
To say the least.
And I think one of the challenges that I've seen this year is the IRS was put in a position to not just process tax information, they were put in a position to execute all these economic income payments. They were put in a position to put all of these child tax payments in taxpayers' hands. And with that challenge, it's really put them in a position to not even deal with all of the normal day-to-day things, having the tracking. And, you know, the IRS, they're at home working. They have the same challenges we have. And that's, you know, they weren't set up to work from home, and they've got people working from home, and there's a reduced workforce that they're dealing with, and they've been required to do additional work for these payments. And the other thing I've heard is, you know, they're behind on the mail. So anytime we can do things electronically versus mail, anytime we can get those right on our tax return, we're going to save ourselves some headaches. I heard at one point in time there was 17 semi-trailers full of unopened mail in Ogden, Utah. Now, I don't know how, I didn't check the facts on that, but I can only imagine how far they are behind because of that remote workforce.
The little things, yeah.
So it's been a challenge.
Well, moving on to some more of those for the credits this year that, you know, consider that individuals should be aware of. What one do you want to hit on next here?
So the next one we'll talk about is the Child and Dependent Care Credit. And so the previous credit I talked about was for working families, non-working families. This is for the working families, both parents working and having to put their kids in some type of child care and pay for that. So at the end of the day, what they did with this credit is, again, make it refundable. Secondly, what they did was take the credit from $3,000 per for the first child to $4,000, and then for children above that first child, it's an $8,000 credit versus a $6,000 credit in the past. And what they did, if you think about that, the qualifying expenses are your daycare. And for one child, you can have up to $8,000 of expenses, or for multiple children, you can have up to $16,000. In the past, you only received 35% credit of those expenses, and they moved that to 50% for a credit this year. So another significant increase. And most of these credits, there are income limitations, so it's really important to understand what your adjusted gross income is, because that will impact the amount of your credit. So when I say it's a $4,000 or $8,000 credit, it doesn't necessarily mean you will get that amount. It's all very dependent upon your adjusted gross income. So again, a very important number to know and understand. And that's a very interesting and complicated credit in that once you hit a certain threshold of income, they're going to revert back to some of their old credit calculations. And once you get to another income limit, they're going to revert to no credit at all. So it's really important to understand those credits and how they're calculated. A lot of our tax software is very beneficial in that. But again, as I said earlier, start early, get the numbers, and make sure you do your research. Because, you know, in that case, for that credit, you're going to have to make sure you know and understand what all of the expenses you paid for childcare are.
You know, again, I think just kind of hitting on having those correct numbers submitted, because of the delay time is just so long, and who knows if it is just 9 months. You know, that's a very big delay time there. So moving on now to the economic impact, the stimulus that we had received. Let's talk on that one a little bit.
Sure. That's the goal was to put $1,400 in everybody's hands. And I think that was, again, something that the IRS did a great job at getting information, getting money into people's hands. And that was passed in March of 2021. And again, it was dependent upon when you filed your 2019 and 2020 tax return, because the amount was based on what your income was in those years. And they sent out all of this this money, and it was $1,400 per person in your household. So if there was, you had kids that qualified, so there's pretty significant money being received by families, and the money was adjusted throughout the year. And depending on your income, your employment situation, you might now be in a situation where you receive more money than you should have. Well, the good news is that you don't have to pay that back. So in one way, shape, or form, you're going to want to calculate the amount of money you should have received, because maybe you didn't receive enough. And a good example of that is you had an extra child, so you qualified for an extra $1,400 because between 2020 and 21, you had one more child in 2021. You could calculate an extra $1,400 for that child because now they're dependent of yours. So it's going to make sense to put that calculation on your tax return. But if you're in a situation where on the other end of that spectrum, you lost a dependent during the year because they are now on their own, when your kids, graduated from college and they've moved on and they're no longer dependent, they're going to claim their own $1,400, but because they were dependent on your 2020 tax return, you got $1,400 for them. You get to keep the money. That's one of the benefits of that. Again, like I mentioned earlier, it's really important to know the amount the IRS calculated that you received, because if you put the wrong amount on your tax return, it's going to be an easy 9-month delay in getting your refund. And there's going to be notices going back and forth. And when we talk about paper notices, significant delay in getting response to those notices. As I mentioned earlier, the IRS is behind. They're working from home. Less people to open the mail and respond to notices. Some situations we're dealing with 6 months, a year later, still dealing with these notices. So it's important to get on top of that.
And then we have one more here, the advanced child tax credit. Before we hop into, we have some business-specific ones after that. So let's hit on that one before hopping over to those business-specific ones.
Sure. Some business-specific things that were interesting this year. The first one is one that really, in a way, caught us by surprise. The governor signed a bill into law on December 22nd, and we refer to it as the pass-through entity tax. And it's actually a big deal. It's a little bit complicated, but if you're a business owner of a partnership or S corporation, you pay personally the taxes on your business. And because of the way the standard deduction works, what happened was you really didn't get a deduction for those taxes you paid to the state of Michigan on your federal tax return. Well, this bill that the governor signed allows the entity to make that tax payment. And if the entity makes that tax payment, that becomes a deduction on the federal return, which could save anywhere from 20 to 37% of those tax dollars. So a very significant change that you can make that election when you file your business tax return in March of this year for those pass-through entities. And the other benefit that was put in place really to help our restaurants was the ability to deduct 100% of your business meals purchased at a restaurant. So our restaurants were struggling, so one of the things they did was to encourage businesses to continue to visit those restaurants, was to make the meals 100% deductible, where those would have only been 50% deductible in the past.
I have a question for you relating to that one. In your experience, when you've talked to business owners, specifically restaurant owners, are they very aware of that across the board, or is that something that you might have had to remind them about?
But, at the end of the day, it's I'm amazed by the knowledge that has been our business owners have, whether it's the business owners or the restaurants. They're paying attention. There's been so many changes this year. Our business owners have really had to focus on tax law, tax changes. We've spent a significant amount of time with our clients just coaching them through all of these changes, how to take advantage of the benefits that are out there, to really understand the changes that have happened this year. It's been complicated, and I know all business owners have worked extremely hard this past year staying on top of the changes. For example, when the Payment Protection Program came out, they said you need to choose between that and the Employee Retention Credit, and then roll the clock forward. They said, wait a minute, if you qualify for the Employee Retention Credit, you could actually qualify for both of these two programs for business owners. So now a lot of businesses, as we get into the end of the year here, are looking at their Employee Retention Credit and finding out there was another available credit to them that they didn't even expect. So it's really important that business owners stay on top of what's going on in the business arena. And like I said, most of our clients we've been in communication with, and they're really on top of the changes that have happened. But certainly have those conversations with your tax professionals, your CPAs.
So that just about wraps up, I guess, what is new, unless there's anything else you want to hit on. But I'm kind of curious now, hopping into unemployment benefits, if you want to discuss that as well.
Sure. So unemployment benefits, some of the key things that happened in this past year with unemployment benefits. If you think back to March of 2021, the IRS said it made a change just for the year of 2020. They said that if your adjusted gross income is less than $150,000, you can exclude $10,200 of your unemployment benefits from your 2020 tax return. So a number of people are now in this unemployment situation. They find themselves in that unemployment situation in 2020 or 2021 that they've never been in before. And they got the break in 2020 that $10,000 of those benefits would not be taxable. Well, what happened here in 2021 is those are going to be taxable benefits. And what happened, if you think back to when we were applying for unemployment, the system was very difficult. It was complicated. It was hard to log in. It was hard to sign up for those benefits. So we finally get logged in, and we've got a decision to make. And maybe we saw the election, maybe we didn't. But do I want taxes withheld from my unemployment benefits? And a lot of people didn't realize they needed to make that election, or they realized it, but were also trying to pay the bills. So they did not make that election, and now they've got taxable income, which is going to cause a tax situation, that might require them to owe $1,500, against their total liability, and it was not planned. And that's just something that they're going to have to deal with this year. But maybe some of these other credits, especially with the child tax credits, et cetera, that will offset some of that additional tax burden from the unemployment benefits.
We kind of hit on them a little bit throughout our conversation of what's new this year, but I kind of want to hit on again some common mistakes that people may make. I guess one of the biggest ones, which you had mentioned a couple times, was just not having the correct numbers and avoiding a potential 9-month delay on any returns. So any other ones that you would kind of just like to lay out there?
So I think the ones that happen most commonly is that delay in getting started. What happens is people don't have all of the information, and they try to do things quickly, so they lose out on tax benefits, one, and two, they estimate some numbers, and maybe the IRS can double check those numbers, and it causes delays in your returns. I think a lot of the online software packages walk you through the questions, and we quickly move through those questions, and we don't answer those correctly, and we don't get all of the benefits. Again, if you get started early, you can do your own research and get those questions answered correctly. But those are some of the common mistakes that we see, as just really understanding the law and how to apply the law there. One of the things that was extended this year too, if you itemize your deductions, is that mortgage insurance is deductible this year as part of your in addition to your interest that you pay on your home. So that's another benefit that was added this year.
It's something else I'd like to hit on. When we talked about it very briefly before we began the stream, was just kind of any additional sources of income, meaning kind of like side hustle culture. A lot of people have that 5 to 9, if you will. Following the specifics on that, is there, even if it isn't that much additional money, what would you say to those people who maybe are working a few jobs there?
So certainly that's happened for a number of people. They needed a little extra money. They had some time, whatever the situation was. And if you think about these 5 to 9, 9 to 5 individuals that you talked about, they're in an employment situation where they're getting a W-2. They have an employer that's withholding federal, state, city, and Social Security taxes from their check. You go into that self-employed type of situation, you need to manage all of those taxes on your own. So whether you've made an extra $2,000, $5,000, whatever that is, this side hustle, you are going to be responsible for paying the federal, the state, the city taxes. And the big one that catches a lot of people because their employer takes care of it 100% or pulls it out of their check is the Social Security. Essentially, that tax, no matter what tax bracket you're in, ends up being 15% of your income is paid to Social Security. So just a round number is you need to be planning, if you're making that $1,000, 15%, so $150 immediately is taxed right off the top. So that's really important that people understand that when they're doing these side hustles. So your base amount that you need to set aside is 15%, and depending on your tax bracket, that could be another 10, 20, 30% on top of that for federal, state taxes. So I think that's the surprise for these side hustles. They put that number on their tax return, and it really causes a tax liability they weren't planning for. The other side of that, though, is there's a number of deductions they can offset. So I think, back to your point about mistakes, they don't really understand all of the rules and information related to owning your own business. And so there's preparation time that you need to put in place and really understand what's a deductible expense. What I talked about earlier, even meals, is it 50% is 100% deductible. And the interesting that relates to that is those are meals at restaurants. It's not every meal that's out there. It's a qualifying restaurant. So you need to understand what type of meal is 100% deductible versus is only 50% or not deductible at all. So, certainly you can offset some of that income with other expenses, but I think that's been the biggest change for a number of people that have jumped into that arena where they're making a little money on the side.
Let's, as we wrap up here, let's talk identity theft. Scammers are out there always. Robocalls, everything is out there. But tax season, you really want to be cautious, whether it's for an elderly family member or someone who's younger and just filing for the first time. What are some of the basic, tips that you would provide there to those individuals to make sure they aren't getting scammed?
So identity theft, it is a big issue, and there's some real challenges right now that the IRS is dealing with because of all of these refundable credits. A lot of times what has happened is they've delayed issuing credits when there is no tax liability, because that's what scammers, that's one way for them to get money really fast is they intercept your credit. So typically what happens is they get a hold of your Social Security number one way, shape, or form. And a lot of people email information with their Social Security number on it. And that email is not secure. It's stolen, those type of things. And that's how people file their tax return and capture your refund. If that happens, it's very complicated. The IRS is talking about making some changes that they still issue the credits, but to protect your Social Security number. The IRS will never call you and ask you for that information. If you get a letter or an email, check that email out. IRS typically does not email you for your information or correspond to you that way. It's typically in a letter. And even with letters that you may receive in the mail, they might look very legitimate, but double check the address. Google the address that's put on that letter. Make sure you're sending and corresponding to the correct address. So there's a couple of just tips there that prevent you from being engaged with one of these criminals that are trying to intercept your Social Security number or tax information. One of the key things that the IRS will typically do is tie your Social Security number with your adjusted gross income from a previous year. So that's one way that if you're giving both of those pieces of information, the only place you should be doing that is when you go online to the actual irs.gov website. Make sure it's not another website. So before you enter that, make sure the website you are at is irs.gov, and then maybe one of the portals in their website.
So, say you're someone who thinks your information may have gotten leaked. What are your first steps?
So there is a identity theft portal on the IRS website, and they talk you through the things that you need to do to protect your information at that point in time. And there is, one reporting it to the IRS. There are some other credit bureaus that you report that information to, but they walk you right through that on the IRS website. But it becomes a very complicated situation, and then the IRS will actually assign a identification number to you in addition to your Social Security number. And that is one of the things that actually was one of the mistakes that I see people making, is they get this letter from the IRS and they don't know what this identification number is, and they set it aside. They don't include it with their tax return. If you've received one of those letters, it's critical that you include that number on your tax return, or you're not going to get your refund and it's going to get delayed. So if you get assigned one of those numbers, make sure you use it.
David, I really appreciate your time here this morning, or afternoon now at this point. Anything else that you would like to add here?
I think we've hit most of the highlights here. I think it's going to be a busy tax season for a number of people. It's, again, complicated, but at the end of the day, reach out to your tax professionals, your CPAs. We're here to help and make sure it gets done correctly.
I appreciate it. Thank you very much. Ladies and gentlemen, the stream here has a link to it. It'll take you over to woodtv.com. We'll have the video here of David and I's conversation that you'll be able to watch through and through once again. This has been a look at the Wood TV Live Desk. I'm News 8 digital anchor Luke Laster. Have a great afternoon, ladies and gentlemen. We'll see you around.